Good evening, friends. This is Rahul Sejwal here. We're just waiting for more participants to join in. Just bear with us for about a couple of minutes. We'll start off in 2 minutes. Yes, good evening all. Again, let me introduce myself. I'm Rahul Sejwal. I lead the Mumbai team for our business development part. Been with ASK for about 9 years now. On behalf of ASK, let me welcome you all for this webinar. It is our continued effort to keep the clients informed on our strategies. And today we are going to discuss on financial opportunities portfolio, FOP as it is known. We have with us Bhavesh Kanani, who has been managing this portfolio since inception. Just to introduce Bhavesh, Bhavesh has been in the industry for long, has an overall 17 years of experience in equity research, both in global and domestic markets. His domain expert, of course, has been in banking and financial services industries. Prior to joining ASK, he has been working with Centrum Broking, Sharekhan, Bank of America, and Citigroup as well. Bhavesh has done his MBA in finance from IBS and has been with ASK for more than a decade now. I would just like to hand over the baton to Bhavesh to take it ahead. For investors, kindly note you can mention your questions and answers in the Q&A box, during or after the presentation. We'll of course try to answer each one of them. So over to you, Bhavesh, to take it ahead.
Thank you, Rahul. Good evening to all the participants for gathering. Let us begin the discussion for the FOP with some bit of good news. Firstly, the performance of the portfolio since the beginning of the year, it has been a great time for the portfolio, with portfolio delivering very close to 15%. Whereas Nifty 50, the benchmark, has delivered a shade lower than 6%. Over the subsequent slides, we'll be able to figure out what is underlying this smart recovery in the performance through the financial performance analysis. Focus here would be more on FY23 more than the quarter itself, because this is the fourth quarter, and that will allow us to understand annual trends for recent few years, including the years during which COVID impacted the financial services industry dramatically. To begin with, let us look at the loan book growth itself. Now, as we can see in the exhibit here, the orange bars are indicating industry level credit growth, whereas the blue bars are indicating the growth delivered by lenders we own in this portfolio. Clearly, we can see that the lenders we own in the portfolio have historically delivered much better growth than the industry average. The same continued in FY23 as well, with FOP lenders growing the loan book by 17 odd percent versus 15% growth for the industry. Let me also emphasize that the industry growth of 15% also has benefit of currency impact. That is for banks who have sizable lending book overseas. The growth in overseas loan book was higher because of favorable currency movements. In absence of that, as we have seen in past, the gap between the lenders we own and the industry average has typically been higher than what it was in FY23. And we remain confident that in future as well, the lenders we have chosen in the portfolio will continue to report superior growth compared to the industry average. Now, with this, kind of loan growth, what becomes important is how much of this loan growth has actually translated into the total income for the lenders we are talking about. So, along with a very healthy loan growth, FY23 also saw net interest margin expanding for all the lenders, primarily because we have had many repo rate hikes during the year. And for many of the banks, sizable part of their book is actually linked to repo rate. And hence, because of rapid repo rate hikes, the lending rates too went up. And as a result, the lenders in our portfolio saw a very healthy growth of 17% in the total income. Now, this 17%, while it benefited from expansion in net interest margin, there was negative trend when it comes to treasury performance. That is, wherever banks have liquidity, they tend to park it in G-Secs as part of regulatory requirement, as well as for short-term liquidity management purposes. And we have seen a spike in G-Sec yields, especially in the first quarter of the year, because of which treasury performance for all the banks was impacted. This particular aspect doesn't impact NBFCs as much because they don't have to hold sizable part of their liabilities in form of SLR. And despite that weak treasury performance, we have seen a 17% growth in total income. Against this smart recovery in total income, we also saw operating expenses for all the lenders going up. This is largely because of overall when business volumes go up, the OPEX also goes up. Hiring had increased to meet the higher volumes, in terms of demand for credit, as well as growth returned, so does the incentive-related expenses for lenders. And as a result, we saw a 19% growth in operating expenses for the lender in the portfolio. Net, when we remove operating expenses out of the total income, what we get is pre-provisioning operating profit, that is PPOP, which grew by a healthy 15%, despite very strong operating expenses growth. I would say 15% kind of growth is a decent delivery. But the most interesting part actually comes after the PPOP line, that is bottom line growth compared to the PPOP growth was fairly high, where we are talking about 15% growth in pre-provisioning operating profit. We saw bottom line growth of 29%. And this was the consecutive third year where we saw bottom line growth upwards of 30%. And if we include SBI as well in this, where there was a sharper delta in the bottom line, the profit growth for the lenders in the portfolio was up 35% for FY23. Naturally, the major contributory factor behind sharply higher bottom line growth versus PPOP growth of 15% is the fact that provisions on NPAs have been coming down for all the lenders, as we have seen improvement in asset quality. Now, if you will just contrast PPOP growth in 19 and 20 versus bottom line growth of the same 2 years, we'll realize that PPOP growth was higher than bottom line growth, because in those 2 years, all the lenders were essentially providing more and more to meet NPA provision requirements, especially so in case of FY20, where well-managed lenders, disciplined lenders decided to start providing very aggressively for NPAs in the last quarter when we had the first wave of lockdowns. Because of very aggressive provisions back when the COVID had just begun, they had created a lot of buffer, which became useful in subsequent years when NPA actually went up because of COVID. And in FY23 as well, those provisions actually came down year on year. And I would say that they have more or less normalized. But for FY23, from 15% PPOP growth, the bottom line growth going up to 29% is primarily driven by normalization of provisions downwards. This is the point I was trying to drive earlier, that asset quality for all the lenders has continued to improve, and which is allowing all these lenders to reduce the provisioning burden on the profit and loss account. Overall, average GNPA for the lenders we own stands at about 1.9%, which is lower than what it used to be before COVID. What all this boils down in form of ROA is a 2.3% ROA, average ROA for the lenders we own, as a result of recovery in loan growth, better net interest margins, and lower provisions. This has resulted into a ROA which is higher than what the sector used to experience even before COVID. And on stock price perspective, we have all seen that the premium of private sector entities, private lenders over PSU banks had gone up dramatically just after COVID. And since then, we have seen a rally in PSU banks in last 1 year, because of which the premium that private entities used to command over PSU banks has begun to normalize and is closer to the average we have seen over last many years. And as a result, we have seen in last couple of months that the kind of stocks we like to own, that is high quality and growth related entities, they have begun to do better again. With that, we can open the floor for Q&A.
Thanks, Bhavesh. I would request investors, participants to try and have any questions, if any, to be mentioned into the Q&A box. Bhavesh, there were a couple of things that, we personally had an internal dialogue with the clients, and some of the questions that I would also like to put up. So in general, equity as an investment horizon always is mentioned in long term, and long term in general sense has been more than 5 years or so. Now, considering last 4 years and above, since inception on this portfolio, there has been a certain underperformance versus the benchmark. Now, two parts to it. First of all, what do you attribute that underperformance to? And, do you see the portfolio having the ability to catch up the performance and possibly outperform in the next 2 to 3 years kind of time?
Okay. Well, so the underperformance primarily comes from the fact that we have had very tough macro. Banking is one sector which is completely dependent on macro, and we have gone through COVID crisis, which is like once in a century kind of crisis. And lending being a leverage business, it tends to have much more amplified impact on the balance sheet and P&L in a time of crisis. Yes, it has impacted the performance dramatically, has taken away a lot of gains we have had before COVID hit us. But if I, look at it from purely financial performance perspective, I'm quite happy and impressed by the manner in which lenders have navigated a crisis like COVID. Both in terms of length of the crisis and far-reaching impact it had in terms of depth of the impact. We have seen nothing of this sort in last 20 odd years. And the manner in which all the lenders could navigate through this crisis by providing aggressively, by always doing the right thing in terms of managing the potential NPA risk, and basically come out unscathed, more or less. ROEs and ROAs of all the well-managed lenders are back to pre-COVID level in at the minimum. In many cases, it is better than what it was pre-COVID. So yes, that has meant that we have lost 2 years in navigating through the crisis. But now that situation has normalized, we have also seen financial performance bouncing back very well. Going forward, my expectation is that the bottom line growth that we saw in last couple of years, which was driven by provisions coming down, incrementally provisions have more or less normalized. It is business as usual kind of trend incrementally. And as a result, for next 2-3 years, we should see a situation where the bottom line growth would largely mirror the balance sheet growth. And when it comes to balance sheet growth, essentially my outlook is that we should be looking at around 12 odd percent kind of industry level credit growth. Private sector lenders, high quality lenders like the ones we own in the portfolio, tend to grow materially higher than the industry. A 300, 400 to 500 basis point higher growth compared to industry average of around 12, 13% would mean a 17, 18% kind of growth on the loan book, which my sense is should get reflected in the bottom line growth as well at an aggregate level. Yes, there will be few entities who will be able to deliver much higher growth and both on bottom line as well as balance sheet. But at aggregate level, the lenders we own should be able to deliver a bottom line growth of 17 odd percent plus or minus 1%. And hopefully that should get reflected in prices as well, because we have seen in last 3 years that financial performance was not getting reflected in terms of price behavior because of many different reasons. But finally, it is begin to getting reflected looking at the way the performance has been in FYTD basis. Incrementally, it should be a normalized scenario from macro perspective as well, and hence we should get back to balance sheet growth getting reflected in bottom line as well.
Yeah, thanks. I think we already seen some bounce back happening, and possibility that you're correctly mentioning in normalcy, we should see that growth happening on the price moments as well in the next couple of years. Actually, that brings me to my second question, which is possibly linked a bit. So we had some significant performance recently on the PSU bank space, and you touched in your presentation as well.
Yeah.
Especially in the financial basket you're talking about, what would you believe that was the major reason that suddenly you saw that kind of a spurt? And do you foresee for that spurt to continue? If yes, are we open to exposure to them going ahead?
Okay. So when we look at the financial performance of PSU banks and the stock price behavior, we will realize that all these PSU banks were reporting zero profits or in fact losses in 2016-17, just after the asset quality review done by Mr. Raghuram Rajan. And so as a result of that review, there were a lot of hidden NPAs which came to surface. And since they came to surface, RBI had forced them to aggressively provide for those NPAs, because of which PSU banks reported losses. On top of that, they had COVID. So for a length of time, right since 2016-17, essentially PSU banks were not lending in the same manner to the corporate world in which they used to lend before 2016. So I'm referring to your large project loans, whether it is in infrastructure or otherwise. Demand from large corporates too was weak because there was not much of capex happening, during those years, and as a result, opportunity on corporate lending was low. This is very much getting reflected in the kind of single-digit growth PSU banks saw in their loan book. Now, while the growth was low, what it also meant was that since they had not done many project finance loans and a lot of NPA had come into surface, what that meant was the books were relatively clean. And as a result, incremental need for NPA provisions was lower, because of which their bottom line, which was implying an ROA of 0.2% or 0.3%, as provisions came down, that ROA picked up from the 20-30 basis points to 70-80 basis points, but still lower than 1% in most cases. So they were coming out of historical lows of financial performance. But even after this recovery from 0.2% to 0.7, 0.8%, they are delivering half of what well-managed private sector banks or NBFCs are able to deliver. On an average, the frontline private banks are able to deliver an ROA of at least 1.8%. That is double compared to what PSU banks, the best of PSU banks are able to deliver in a situations where provisions have actually come down dramatically. Incrementally, as economic activity has picked up, loan growth has picked up, it is not likely that provisions will continue to remain very low. As lenders build books, as natural course, your NPAs tend to normalize upwards, and hence, that's the key reason why we believe that despite this smart uptick in some of the PSU banks, it is not a fruit of their actions. Rather, it is a result of a few years when situation was extremely bad, and from those horrible years, they have just normalized to where they were before 2016. So, and still the gap versus private sector banks in terms of return on equity and return on asset still remains as large as it was. Incrementally, for PSU banks to do well, they'll have to actually reinvent themselves to ensure that their ROA goes above 1%. It crosses this glass ceiling of 1%. They'll have to do radically different things like get into retail lending beyond mortgage sector. Today you will not find PSU banks doing personal loans aggressively, credit cards, small business loans, vehicle loans, and all, which are fairly high yielding compared to your mortgage segment. If we see a possibility of that happening in any PSU bank, then there is a chance that they'll be able to break out of this 1% ROA ceiling, and then it would make investment sense. While we have not owned many PSUs in past, let me clarify that we don't have any specific allergy to PSU banks. It's just that when we are talking about a cost of equity of 12-13%, you would want to select banks or lenders who are able to deliver a 15-16% kind of ROE at least. The more the better, but at least they should be able to deliver higher than the cost of equity, which has not been the case for most PSU banks. We do own SBI now, largely driven by the fact that they have realized that they need to increase their share of retail lending in the portfolio. They have started to do personal loans under a product called Express Credit through YONO app. They've already built a book of 3 lakh crores within a short span of time, and that portfolio is doing well. So there are few banks who have realized that they need to improve their marketing abilities to develop the retail book further, and that should over time start to get reflected in ROAs. Last 10-year average ROA for State Bank will be 90 basis points, not even 1%. With this increasing share of retail loans in the loan book, we expect that they will touch 1%, and with time they should be able to cross that 1% as well over medium term. So just to highlight that we do own a PSU, but the only reason to get into PSUs, if at all, is that it should make a lot of sense in terms of financial performance and delivery. We are unlikely to take the risk of getting into poorly managed banks where for a phase their return ratios may look great, but they tend to remain susceptible to economic cycles. We want lenders who can navigate through tough period without much damage to the balance sheet of PNL, and that stays.
Yeah, thanks for that elaborative answer. I think it answers the ambiguity part of it, of getting into a PSU or not, and our thought process onto that. There's a question from Darshit here. He's mentioning about the aggressive rate hikes might result into NPS going forward, since the rate hikes have lagging effect on credit defaults. I mean, your thoughts on that?
Yeah, well, so in terms of rates, we have done a fair bit of road trips to understand the impact of interest rates on various strata of society, including people who are taking very small affordable home loans like 10 lakh, right through SMEs and large corporate. In absolute rate comparison, if we will compare today's rates, they are more or less close to where they were pre-COVID. So it is not a situation where we are looking at EMI amounts which were not experienced in last 5 years. Secondly, the repayment ability has also normalized for borrowers as economic activity has normalized. And as a result, so far we have not seen lenders trying to violate the basic tenets of lending. That is, there's something called FOIR, that is fixed obligation ratio in context of the income. Those ratios across lenders continue to remain around 40%, which was the case even pre-COVID. So, the lending, whatever is happening, whatever is the rate hike implying in terms of higher amount, it is still within the repayment capabilities of the borrowers, and hence we have not seen any spike in NPAs. In fact, the asset quality continues to improve. As the old NPA cases which came up during COVID are getting resolved, and the fact that these NPAs are coming down is because the cases are getting resolved. NPA cases get resolved only when the borrower has got cash flows to not only pay the current EMI but also pay for the past due EMIs. So ground level situation today doesn't indicate any spike in NPS because of interest rate hike. Moreover, just imagine a borrower is considering taking a home loan. He would first like to have absolute clarity on his income levels more than the interest rate or property rate prevailing. Only when a borrower is confident of consistency in cash flow over next 1-2 years, he or she actually goes for a home buying decision. So, in my humble understanding, clarity of cash flow is what first comes to a borrower's mind, followed by the economics on interest rates and property prices when it comes to a home buying decision. So, naturally, we are keeping a very close eye on the incremental trends, and we'll certainly take necessary actions wherever needed.
Yeah, thanks, Bhavesh. There is one more aspect of we not owning any asset management companies.
Yeah.
Are we viewing this particular segment? Looking forward to your views on that.
Certainly. So savings is an opportunity, is an amazing opportunity. Even when we came out and met many of you, in the initial part when this fund was launched, we were very excited about the savings opportunity, and we remain so because today, even after all this penetration, unique mutual fund investors are not significantly higher than 3 crore, 3.25 crore. So opportunity definitely is very high, but the asset management space and by connection, even the wealth management space continues to face significant regulatory headwinds. The profits of asset management companies have not moved in last 2-3 years. And now, last couple of months have been pretty busy in terms of news flow from SEBI when it comes to them reviewing the new TER structure and including a lot of expenses which were charged over and above the base TER. Now there is this proposal that all of these expenses will be part of the base TER, whether it is GST, brokerage related expenses, and whatnot. So there was a lot of ambiguity on the profitability part of the AMCs, and hence, after exiting HDFC AMC at a very good price, we did not decide to enter into AMCs or wealth managers until we have absolute clarity. And that definitely doesn't mean that it is off our radar. It is very much a very interesting story to capture savings opportunity. And we are extremely vigilant. And as soon as we have more confidence on the sector dynamics, we'll again consider investing in one of them.
Noted, Bhavesh. Important question here. Bajaj Twins is a part of majority of our portfolios.
Yeah.
So, your thoughts specifically on would they have the same kind of capability to deliver that they have been doing so in the last 8-10 years? With Reliance coming in or possibly, into that particular space, do you foresee that as a, threat to the market or threat to probably Bajaj for that?
Yeah, see, as far as growth is concerned, naturally the yesteryear growth of 35-40% for Bajaj at current book size is not possible. Especially when it comes to a well-managed lender, the lender would always want to calibrate the growth in line with what economic situation is allowing them. It's not difficult to distribute loans, but if you are distributing loans and creating over leverage situation for borrowers, you are going to face a lot of defaults, which is what every lender wants to avoid. That can happen only when incremental growth is happening in a calibrated manner, which is what we believe Bajaj has been doing. And even today they are well placed to deliver a 25% kind of loan growth for next 2-3 years. And we already talked about what kind of growth industry can deliver, which is around 12% for the credit opportunity. So a 25% growth for Bajaj versus a 12% growth for industry is, I would say, is still a very impressive delivery, which we expect to happen over next 2-3 years. And as far as entry of geo financials is concerned, at this stage, we do not have clarity of the structure they have in mind or the products they want to do. But I would conceptually would like to submit that lending is not an easy business. It is really not about giving away money. If I stand on the crossroads with 10,000 crores in a bag, I can disburse those 10,000 crores in matter of hours. But it is about getting the money back. So yes, Reliance has proven in various businesses that they can achieve scale and beat competition at rapidly scaling up the size. Lending is different from the businesses they've scaled, whether it is telecom or retail. So it remains to be seen what format they decide to come in. They'll have their own learning curve in terms of building the lending business format, underwriting policies, and other associated things. And Bajaj, in its own right, has created a business model right under the nose of very large private sector banks and has defended their dominance in certain segments. So at this stage, we do not have significant information on Geo to really say how they'll do and what they'll do. But when it comes to ability of the lenders we own, including Bajaj, we believe that they have steep enough learning curve to defend the turf. As and when details are out on Geo Financial Services and it demands a review of our stance, we'll certainly do that.
Yeah, one more. This is probably related, but I mean, your thoughts on Axis Bank specifically. This question is from Mustafa. Reason being that it has been able to deliver performance in the recent past.
Yeah.
And in that, then if you're wanting to change a portfolio stock, what are the things that we look for, while change of the portfolio stock?
Certainly. So first thing is naturally track record plays a very important role. And by track record, I mean how an entity has navigated through crisis in past. That reflects on a lot of important aspects like the underwriting abilities of a lender, what kind of segments where a lender has built its strength and niche, and how well they are able to deliver superior margins versus others because they have expertise in certain segments. Even in turnaround stories, we do take sufficient enough time to really build position. We have had ICICI Bank as part of the portfolio. We took our own time to gain confidence on sustainability of the turnaround. And Axis, by all means, is turning around, and they are, already delivering an ROE of 1.8% odd. Although there was delay in this turnaround just after Amitabh joined, but that turnaround has happened, and incrementally they seems to be set on, delivering consistently. There are, while we like the stock and we may consider it introducing in the portfolio, but there are certain regulatory aspects which comes in way, especially because of related party, related regulations where we may not be able to own some stocks in the portfolio because ASK as an entity has a common director with a potential investee company. So the regulation says that and that is not allowed. We need to get consent of clients before getting into such kind of investee companies. But financial performance wise, Axis seems to be turning our way.
I think one last question that we have, this is more related to politics because we have elections next year. How much of an impact do you see in case the central government does not come to the power in the same manner that it had done last time? So would you see a major impact happening on the banking as a sector, or wouldn't really as matter?
Well, I mean, we have a fair bit of long history of financial stock performance, even when this government was not in power. So we have last 30 odd years of history to look at, and the trend and study suggests that yes, government has an important role to play, but it is not the performance or delivery of banks is not solely driven by the party in power. It may have more implications for PSU banks because the manner in which PSU banks are run has changed over time in terms of how political power can influence, credit decisions, quality of the decisions taken by the board, quality of board itself, and stance of government when it comes to implementing debt waivers and things like that. So PSU banks functioning is relatively more influenced by the quality of political party that is in power than private entities. You look at HDFC Bank, ICICI Bank, and all these leading private lenders. They function well across various regimes, and they'll continue to do so. As a side note, we should also remember that even if current party does not return back to power, they'll remain influential in the overall scheme of things and how the economic policies of India get structured. Some of the reforms that they have set in motion cannot be reversed. Things like your UPI, things like your Aadhaar getting linked with bank accounts, the number of bank accounts that got opened under the Jan Dhan scheme, the kind of life insurance and accidental coverage government schemes have offered to the masses in India, the manner in which various economic decisions are taken. So there are certain things that are not really reversible in the short term, even if there is a change in power. And well-managed entities, anyways, will find ways to navigate through whatever challenges are thrown at them. We have already seen how well they have navigated through COVID. So navigating through political challenges will not be that big of a challenge, in my view.
Perfect. Thanks. I think no more questions currently in queue. I'll just request participants if they have any further questions to put it in the Q&A section. Bhavesh, will just wait for a minute or two. If
Sure.
not, then we'll... Yeah, I have one more question here. expectations of the portfolio returns over the next 3 to 4 years, and what is the estimated earnings in the FOP portfolio for next about next 12 to 18 months.
Okay. As I was discussing earlier, when we were talking about that slide on which for 3 consecutive years, the lenders have delivered a 30% plus kind of bottom line growth. If you recall, I mentioned that that was primarily driven by reduction in NPAs as asset quality improved. Large part of that improvement has already happened. As we saw, NPA average for the lenders we own is down to 1.9%. So incrementally, the provisions are where they would be in normal course of situation. And as a result, whatever is the balance sheet growth, the bottom line growth will more or less mirror that growth. On balance sheet growth, my understanding is that the lenders we own today should be able to deliver 16-17% kind of balance sheet growth on advances front. And similar should be the expectation for bottom line growth at aggregate level. In last couple of years, the connection between financial performance and stock price has got distorted to an extent, but as situation has normalized to a great extent, we believe that this financial performance, that is bottom line growth of 16 to 18%, should also get reflected in price performance as well. And so over next 2-3 years, keeping fingers crossed that we do not have another crisis around the corner, we should be able to see about 16 to 18% kind of return from the portfolio, including dividend and before fees.
Okay, there's a question on our insurance portfolio of the companies. So is the COVID-related pain on insurance businesses behind us? Do you see the growth and profitability coming back on path?
Yeah, the pain of COVID has already kind of been passed through the PNL. So incrementally, insurance companies are behaving pretty normal. In fact, the reinsurance rates had gone up after COVID because the global reinsurance companies were charging tighter rates out of the fear of adverse impact of COVID on the number of deaths in India, or for that matter, health insurance claims. Fortunately, the experience has been better, and there is a case for reinsurance rates to actually come down, and that will be positive for life insurance companies if that happens. So as far as COVID-related impact on general insurance companies due to health insurance is concerned, that hit was already taken, more than a year back. So there is no incremental pain as such that COVID can have from here. It's business as usual for life insurance companies and general insurance companies.
Yeah, I think we have room for one last question. Talks about your view on equity brokerage stocks.
Well, broking as an industry doesn't have a very solid kind of pricing power. It is a commoditized product. Yes, some brokerages have done well. That is, discount brokers, likes of Angel, Zerodha, they've taken market share away from traditional broking entities like your Motilal, your ICICI Securities, and whatnot. So there is a little bit of concentration happening with the discount brokers in terms of market share. But when it comes to our ability to predict how the volumes will behave, because today broking industry's profitability is heavily dependent on option volumes. And if you look at SEBI's own data, a very minuscule percentage of total clientele of broking industry is able to even make FD kind of returns out of trading. So our ability to predict what kind of volumes will sustain on option side for the broking industry is limited, because data suggests that all these volumes is happening from retail traders. They are actually not making money. How long will this continue? That is, retail investors still participate in options market without actually making money. I don't know how long will this continue. I don't have the ability to predict that. So because of that inability to predict how volumes can behave over long term, we have decided so far not to enter them.
Your thoughts on Kotak Bank?
Kotak Bank, I mean, there is an impending management change there. Other than that, the bank continues to do well. They have one of the highest ROAs in the industry today, one of the best margins. So management change is the only thing that we are watching very closely. You would observe that within the FOP lenders, Kotak has one of the least weights within the lenders that we own, and that precisely reflects our concern, or the management change related actions or news flow is getting reflected in the lower weight for Kotak in our portfolio.
Thanks. Thanks, Bhavesh. Thank you for giving out your thoughts. Just one last question that's coming in, because you've been interacting that way. Your thoughts on HDFC Twins. Do these have chance to be included in our FOP in future?
Well, both of them are already part of FOP.
Correct.
We entered HDFC Limited a few months back, and we believe that HDFC Bank has gone very aggressive in opening branches in last fiscal year. And after merger, it will be the second largest financial institution after State Bank of India. And that will have its own advantages. We know for a fact that HDFC Bank was not offering its own mortgage products. Rather, they were selling mortgage product for HDFC Limited. Now, HDFC Limited only had some 650 branches. HDFC Bank has 7,000 branches. So once HDFC Bank rolls out mortgage products in all these 7,000 branches, you can imagine the pace at which they can, build the mortgage book on the merged entity basis. So, it's going to create one of the largest financial institutions with a lot of dominance in the industry. And it's our positive stance that is getting reflected in the fact that we own both of them in FOP.
Done. Thanks a lot, Bhavesh. I think we will have to close this now. Thank you all for your presence here today. Looking forward to keep engaging in future. Happy investing, all of you. Thank you.
Thank you everyone for coming up for the session, and very wonderful questions. You all have shown a lot of faith in this product despite many difficult years in past. It is hopefully performing in line with your expectations now incrementally. It was a test of times for us as well as our investment philosophy of staying put with high quality names, because that is what we believe in. And I thank every one of you to for keeping the faith in our investment philosophy and staying put with us. Incrementally, the times are great for financial sector. This is one of the sector that offers a decent amount of value in terms of growth and the price at which stocks are. And given the runway that is right ahead for the Indian economy. This portfolio should be able to perform according to its immense potential. Keeping fingers crossed that there is no other crisis around the corner.
Thanks for your closing comments, Bhavesh. Thanks a lot. Thank you all again. Take
Good
care.
day, everyone.